Tensions in the Middle East are hotting up, and last week we saw Iran launch a barrage of drones and missiles at Israel, promoting air defense to kick in with the help of Western fighter jets, as well as the Saudi Arabian military too. And just the other day, Israel launched a retaliation attack back at Iran, which caused relatively minor damage, but this could just be a scout attack to test air defences before a larger scale response takes place. Now, this heightened conflict in the Middle East region means that the next few weeks are going to be pivotal in how large the consequences of this conflict are on the US and the global economy. And depending on how far things get escalated, this could ultimately result in a black swan event taking place. Amongst the uncertainty of this situation, we have seen declines in the stock market, while various commodity prices stayed stable or even started to rise around future supply concerns from this conflict. And although oil is a commodity that did not see an immediate spike in price in the aftermath of the Iranian airstrike from last weekend, there are many concerns around imminent supply shocks and production disruptions, which could lead to a huge increase in oil prices, especially if tensions in the region get any higher. We have already seen a pretty concerning rise in oil prices since the beginning of 2024, up over 20% year to date, and these fresh missile strikes from Iran on Israel only escalate the conflict that we are seeing in the region, as well as worsening Iran's relationship with the US and the West. Iran is the 7th largest oil-producing country in the world, responsible for producing just over 4 million barrels of oil a day, which is approximately 4.9% of the 83 million barrels of oil that are produced every day globally. Now, all of this supply that is coming from Iran is now at major risk of being disrupted, whether that is as a result of economic sanctions from the West or directly from the production process being slowed down or even halted. Now, Iran has also seized an Israel-linked ship near the Strait of Hormuz, one of the major global energy choke points in the Middle East region. About 30% of the world's oil passes through the Strait of Hormuz, which is about 34,000 ships annually, most of which are tankers, according to the IMF Port Watch. Lipao Oil Associates have said the worst case scenario for oil supply is Iran attempting to disrupt tanker traffic in the Strait of Hormuz, which could send oil prices spiking to $130 per barrel. Now, that is roughly a 50% increase in oil prices from today's price, which would be absolutely catastrophic for the world and have many negative knock-on effects for the US and the global economy alike. The Middle Eastern region in general is responsible for producing 31.3% of global oil supply, meaning that this oil supply is at risk too if there is to be any congestion and disruption around this Strait of Hormuz, or if the conflict between Iran and Israel breaks out into other countries too. Iraq is a particular country of concern, as it is an even bigger oil-producing country than Iran, and is a country who is very close allies with Iran and is also one of their largest trading partners. Now, Iraq is responsible for producing just under 4.4 million barrels a day, which is 5.3% of the global total, and this oil supply could also potentially be at risk from sanctions or production slowdowns, depending on how things do play out. Between Iran and Iraq, that is over 10% of the global oil supply, which puts oil prices in a perilous position if the conflict is to escalate any further. The US is in a particularly sensitive position when it comes to oil prices right now due to how depleted they have let their strategic petroleum reserve get to, now at 364 million barrels. Now, this is far lower than just a few years ago in 2021, where the reserve was in the mid 600 million range, as well as far lower than the historic average number of barrels that they have kept in this reserve. Now, this is mainly thanks to large numbers of barrels being released shortly after the Ukraine and Russia conflict began, where oil prices did spike. The US has actually recently started to buy back barrels of oil to replenish this reserve, which had got to concerningly low levels. However, this is going to now be far more costly if they are to continue doing this. We have also seen a recent increase in global freight shipping costs as well, so this is also likely to get worse now due to higher fuel costs and potential shipping channels being closed or disrupted. Rising commodity prices and shipping costs as a consequence from this Middle East conflict raises the global supply chain pressure, and we know that this leads to upwards pressure on inflation, as can be seen from this chart showing the historical correlation between the global supply chain pressure index and US CPI. There is a very clear trend with CPI following the direction of the supply chain pressure index, but just lagging behind by 6 months or so. When we inevitably see this index rocket upwards in the coming months as a result of the rising global conflict, then this is likely to drive up CPI readings in the back half of 2024. Inflation was already on a rocky path before the events of last week took place, and it was far from being defeated, with the latest few CPI readings coming in hot. In fact, the latest reading for March not only came in higher than expectations at 3.5%, but it was also an increase from the 3.2% for the month prior in February. So with CPI already heading in a concerning direction, the events that we have just seen in the Middle East are only going to make things a lot worse and increase the upwards pressure and momentum on inflation. Now, inflation surging again and remaining at these above target high levels is likely to mean that interest rates remain higher for longer and therefore potentially mean that there are no rate cuts at all in 2024. Now, depending on how out of control inflation does get, we could even see the Federal Reserve be forced to actually hike baseline interest rates even higher than what they currently are. This would have a number of dire consequences for the US economy, as many sectors of the economy have already been struggling a lot at the current high interest rates, with some even being pushed to breaking point. High interest rates are putting immense pressure on the banking sector, particularly regional banks, who are seeing massive unrealised losses from underwater assets that were acquired before 2022 when interest rates started to rise. Higher for longer interest rates will inflict more paper losses on banks who will see these assets that they hold plunge, such as US Treasuries, corporate bonds and mortgages. Now this drives more fear and uncertainty for investors and customers of the bank and increases the chances of a bank run taking place and the bank to collapse, as we saw a number of times happen last year in 2023. With consumer debt, including credit card debt, at all-time highs right now, these high interest rates are also going to inflict a lot more pain on consumers who are seeing their costs surge compared to a few years ago. And this is even worse for homeowners taking out a new mortgage, with both the average 30-year fixed-rate mortgage rate as well as the housing payment to income ratio both at sky-high levels, and both of these metrics are currently sitting above the peak that we saw during the global financial crisis. So who exactly is funding all of this conflict? Well, the United States has funneled many billions of dollars into various regional wars in the Middle East, including this one. Israel has been the largest recipient of US foreign aid, receiving over $300 billion adjusted for inflation in total economic and military assistance. And for last week's Iran attack specifically, the US spent over $1 billion on missiles before shooting down drones and missiles to protect Israel, which will now also need to be replenished. But the crazy thing is, the US has also given tens of billions of dollars to Iran as well, so they are essentially funding both sides. And according to a new spending package plan, the US wants to send a further $14.1 billion to Israel, along with various other financial packages for other wars and military operations. And in fact, just as I'm editing this video, there's breaking news coming in that the US House has approved $60.8 billion in aid for Ukraine, $26.4 billion for Israel, and $8 billion for Taiwan. The question really has to be asked, how can the US fund this? Because right now, looking at the budget deficit, they certainly cannot afford it. The Congressional Budget Office is forecasting the US budget deficit to worsen over the coming years and decades, while at the same time we are also seeing the government borrow more and more money, which is leading to surging government interest payments. So with all of this talk about higher for longer interest rates, this puts the housing market at imminent risk, as cracks have already started to emerge that current house prices are simply not sustainable. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. So aside from that, if you enjoyed the video, please leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.